Yeah, I'm losing my
The Small
edge.
Exchange newsletter, big segment here, a lot to cover. We've been coming out with this small newsletter for our subscribers now for a few months. People are loving it, but a number one question that we get from it was funny. I got an email the other day that was so nice, and it was just like so emblematic of the problem with my mind sometimes and the stuff that I create. This very kind woman emailed in, was like, I love getting this newsletter and it's really nice. It looks nice. And trust me, it looks really well. We're going to dive deep into how it looks and everything. You can see here what the first page looks like. But she goes, I wish I knew how do I read it? And I was just like, good question. Let's do a whole segment on it and get everybody up to speed on how to read the newsletter. It's not in, Latin or Arabic or anything like that. We're not talking about reading a different language here, but just how do you use these metrics? Because Michael, we are coming out every single week for the Small Exchange subscribers with advanced metrics. These are some of the same metrics that we send to market makers and everyone down the line going to our small subscribers. You like this newsletter, right? You got to say yes.
This newsletter, for one, is absolutely beautiful. The whole creative team, and yourself included, did a great job designing it. But two, it's dense. I mean, this is a lot of great information. There are millions of other newsletters you could be subscribed to in the world, but if you're not subscribed to this one, you're really missing out on some solid information when it comes to your trading. It's not just market commentary and someone's opinion, but it's real hard, cold math and useful statistics.
It's funny because we started out with 3 products here at the Small Exchange. And with those 3 products, I was like, let's launch this newsletter. Let's give it to our subscribers, give them a bunch of the numbers that I used to crunch as a professional trader at the Board of Trade, and I think are useful for these people. And the reflection that I got from the higher ups were like, you can fill a whole newsletter with 3 products. And I was like, oh, baby, let me show you. Let's dive into just the first of our 4 pages. And what's great is we've added 2 new products. As you can see here, there are 5, and we're going to add more products in the next 2 months, more products in the next several years. And you're going to get these diagnostics on all of those products. But starting with the Trade the Smalls page, Mikey, this thing is really divided up into 3 sections past that first intro page, which is, meant to just get you on board. We send this out on Monday morning. And so if I go back real quick, this first page is just like, you're having your first coffee, you're rubbing the sleep out of your eyes, and you're like, all right, where are the smalls relative to their highs and lows? That's that left section. And then what's some quippy article that Frank can cook up where he likens markets to, what did I just write about? Christopher Nolan movies. That's this next week. I was likening foreign exchange markets to Inception and Tenet and all those confusing Christopher Nolan movies. And so it's supposed to just get you kind of break in your Monday morning, but then it gets real complex, real deep. And that's why we're diving deep here to explain this. The Trade the Smalls is the first page here that's designed to really give you some stats that help short-term speculative ideas. Like when you're trading futures and you're looking to profit from strategies, Mikey, that can range from 60 seconds to 60 minutes to maybe a couple of hours, this is the page that you are most likely going to hang on. And it starts with, and we're going to come back to this a lot, this measure, it starts with the standard deviation, because this is built in to a lot of professional trading systems. It's built into span margining. It's built into creating, volatility models and how people buy and sell volatility markets like the VIX. It's built into how market makers create ranges and decide where where to get in and out of markets. It's really essential to everything. And maybe, Mikey, you can do a little bit of the theory talk on this, because it's as simple as like a measure that tells you, it's a quick synopsis for what is the range here for this market with a 68% confidence interval, 95%, and 99%. Maybe you can illuminate a little bit further what a confidence interval is and what that means here with this 86, 171, and 257 for our small stock 75.
Sure, I'd be happy to. And these stats, like you mentioned, are updated every week. So they're perfect. When you start the week, what is your expectation on how much this single product can move in a given time frame? And when we're looking at this bell curve in the day in the life graphic here, you're seeing 0.86, 0.86. We're saying about 68% of the time, the variance in this product is going to be 86, either plus or minus. You extend out to that lighter gray, $1.71, 95% of the time, we can capture that movement plus $1.71, minus $1.71. And then finally on the tail end there, that latest gray, $2.57, 99% of the time using this historical data, we've seen the product move up 257 or down 257. So setting some really clear probabilities around movement in each of these 5 products.
Yeah, to me, it's kind of like a heat map that lets you know where recent closes live. You know, like in the same way where it's like, oh, like the dead center of like the city of London is like very highly concentrated. And then as you branch out, there are these different pockets of where people live. It's like, where has the market closed? Okay, 68% of the time you can see it closes within 86 cents. Okay, 95% of the time, it's a little bit wider, but I'm getting 95% of the population of movement for this market. And then almost all occurrences for this market, Michael, are within $2.57. And these update weekly, and you can kind of gauge on in volatile periods, these numbers will get larger because that just means the market is seeing, you know, more $1.50 moves, more $2, $3 moves. And what I use these for are for both where I want to enter a position. You know, if I'm looking for short-term opportunity, Michael, it's usually in the larger moves. So if a market has a 68% one standard deviation range of 86 cents, when it moves to 90 cents or $1 or $1.20, I know, hey, this is a bit of a rare occurrence. This is probably where there's likely to be some opportunity. Also, on the flip side, it's good for expectations of what I can take out of this market intraday. You know, like if you're seeing this 86 cent one standard deviation, that tells me that if I'm scalping intraday, I shouldn't be looking for a $1 or $2 move in my favor, because you can see that only happens 1, 2, 3% of the time that you see a big move outside of $1.50 or $2. So that tells me, okay, if I get 40 cents or 50 cents in this market on an intraday scalp, that's pretty good. So it's good for monitoring opportunity intraday and expectations around that opportunity after you put it on. Now, this is an interesting one that we cooked up ourselves that is, to me, kind of like an outlier index. To me, it's a quick number that lets me know what it actually is. Like the actual numbers being crunched here is the amount of time in the last 3 months that the small product has moved outside of $1. And we do that, Mikey, because $1 is a big move in most of the products. So a 26% means, okay, we're seeing big moves in this product about 1 in every 4 days, 26% of the time. You see, like right now, the SFX product, for instance, the US dollar, while it has moved lower, it's not moving a lot, not seeing a lot of outliers. I think that number is more around 3 or 4 or 5%. We've seen sometimes, especially recently, the metals product has a dollar plus indexed close to 40 or 50%. That's just letting me know, Mikey, that there's one, a lot of moves outside of that $1 that smalls tend to live inside of. And two, there's a lot of opportunity for me in those big outlier moves. And it seems kind of counterintuitive to say there's a high percentage of outliers, but it's just letting you know, hey, if this number is 20%, 30%, or 40%, this market is moving.
Yeah, it's great if you're just learning how to trade and you are trying to determine how much volatility you want to take on. You can look at these dollar plus indicators for each of the products and say, okay, yields are moving less than $1. And remember, guys, $1 is $100 in small exchange futures because each 1 cent move is equal to $1. But if you want less risk, you can move on to a product that has a lower dollar plus percentage, or vice versa, like with metals, where we were down $1.50 already at the open. So those $1 moves are much more likely in metals than they might be in something like yields.
No, that's a good way. I always think of it as, like, I'm always looking for, as you can tell with my recent history of getting into car accidents and being an idiot in general, I'm always like, give me the thing that's moving, give me the fast thing. But it totally works as well for, like, I'm dipping my toe in here. What's the market that's seeing the least amount of outliers? That low percentage can make you a little bit comfortable in the fact that this market recently has not been exhibiting large moves. So it works on both sides of the spectrum. This is our newest addition to the newsletter, and one that I really love, which is the 5-day forecast. And honestly, it works to me the same as your weather app on your iPhone here, which is to say, like, okay, the first day, you get this on Monday, so it's structured on a normal trading week with no holidays. It's day one is Monday, Tuesday, Wednesday. You know, everybody knows how weeks work. But it's just the high and the low, the projected high and low for this market. So this market, for instance, probably started the week around like $68.50, Mikey. And so, okay, the first day, the high and low expectations are 69.50, 67.70. It's the same as like I said, that weather app where it's like we're expecting a range between 20 degrees here in Chicago and 43, and it might get up to that high and down to that low. But using the one standard deviation, this is where we're projecting it to settle inside of. And once again, it's just a barometer to, okay, it's Wednesday afternoon and this market is all the way down at 65 or it's all the way up at 73. This is abnormal. I think there might be opportunity. How do you view this forecast? I don't think I've actually gotten your thoughts on this new metric.
Yeah, this is great. And we've used this with like option pricing, for example, to project expected move in an underlying. I think it's nice for setting those levels. You're kind of taking what was in the bell curve and adding this time factor. So you can see, the cone is increasing because volatility increases with time, not linearly, but I think at a square root. So if you're looking for a longer term trade, let's say you want to do the intraday, you can use the bell curve we showed on the first slide here. But if you're looking for a 3-day or like a 5-day scalp, now you can use something like this where, okay, we're actually considering recent volatility here and how much further the underlying can go. So great when you're expanding your time frame beyond a 1 minute or a 30-minute or a few hour trade.
Yeah, and that's a great point. Again, and most of these metrics are great for gauging opportunity and the flip side of that coin of, expectations when I found my opportunity. And this is another one. It's like if I'm long on Monday, Mikey, and it's Wednesday afternoon and the market is at $71 or $72, that means to me like, oh man, okay, I got a good amount out of this long position. Maybe it's time to get out. And on the flip side of that, you can also gauge like I'm long from Monday, it's Wednesday afternoon, and the market is around $70 or whatever. But I am waiting until it gets up to 75 or 80, and it's like that's maybe not a realistic opportunity in this market for this week. And yeah, it's once again modeled all these numbers. I'm not coming up with any of these numbers. Like these numbers are all number crunched, standard deviations. This is via realized volatility that takes into account standard deviation of daily closes. It's all kind of built off of the same numbers, but giving you different perspectives on all of those products every single week. The next page, Mikey, is a little bit longer term. This is invest the smalls. It's kind of the emissions test for your car is to this diagnostics test for a market for your long-term long or short plays. And diving right in, you can see for each of these markets, you have the recent returns. And so in this example, I think this is the SM75. Okay, in the last 3 months, this market is up 32%. And it's showing me on a month-by-month basis, the wiggle around that is around 6.5%. So if I want to develop a long or short position, I know where the market has been recently. I can see that whole path. It was a little bit of a sell-off and then almost just a straight up grind to up 32. And what can I expect for the next month of action? Well, plus or minus 6.5%. There you go. You have the context to make your long or short bias. If you're going with trends, you might like a long position. If you're a contrarian, you might like a short position. 32% is a lot in a 3-month span here. And then you can know here, well, if I get short and the market falls 5 or 6%, well, that's actually a pretty good return as opposed to if I'm waiting for 10 or 20% in a month, I'm probably not going to get it. This is a pretty nice for those longer term traders, right, Mike?
Totally. And also for the investors in the audience, if you've read finance textbooks, for example, return and volatility are the two kind of most important factors when setting up a portfolio. You can pretty easily derive a Sharpe ratio here if you look at the returns divided by the volatility. So like on a risk adjusted basis, you can compare products with percentage as opposed to the nominal value. So I think really useful in that sense as well.
Love that you just went there, because those are some nerdy things that I do not know about. Sharp ratios. Wow, did not see that coming. And lastly, this is another one that's great for context, not necessarily building a lot of necessary opportunities. But it is good to know, like, if I'm buying or selling this thing, what is the largest component? In SM75 right now, it's Tesla. The weight at 3.5% isn't really that big relative to S&Ps or NASDAQ that have, 10 to 15% in that top holding. So, okay, so it's a diversified index, but what has Tesla done and how has it pushed this index? And you can see here that this largest component in Tesla has driven out of that 30% in the product itself, it's driven over 3% of it. That's a lot. And that kind of can help you develop, do I want to be, if I was going to be short this, do I want to be short, 3% of this product being Tesla? If I like Tesla, then maybe I don't like this short position. Maybe I like going long. It's just helping build more context for your long or short biases. And we do this for all of our asset classes.
Mm-hmm. Yeah, I think it's really useful too when you look at something like the dollar or something like a precious metals product as well, to see how much is really being pushed around there, because they're more heavily weighted in certain components, like the euro is a big component of the dollar and gold is a bigger component in precious metals. But nice to look under the hood here. If you're a Tesla stockholder, this may inform your decision making on whether you want to hedge part of your position or add to it with SM75.
Yeah, no, great for hedging as well. Like if you wanted to hedge out some Tesla, it's up 100%. I'm long SM75. I could sell a little call spread in Tesla against it. And I'm glad that you bring up hedging, because the last page here is maybe not at face value the sexiest page, but it's actually got a ton of, this is probably the densest page. It's got a ton of numbers in it, and it helps people with risk management. And as you can see there, if you can squint at that top left section, something that I think is really nice for people to get on board with pairs trading is when you think about hedging a position and it's like, oh, I'm long market X, it's up 10% in my favor, I'm going to hedge 50% of the position. If you take that hedge percentage to 100, you've just got yourself a pairs trade. And so what we have is, one, a nice pair of the week feature, a little bit of writing and charting around something that we think is maybe a good highlight to look at, a pair that's really moving around recently. But what you've got here, Mikey, is that 100% hedge creating a pairs trade. You've got all the ratios, you've got correlations, and this is really helpful for setting up either, those partial hedges. So if I'm long, IWM, or I'm long the micro ES, I know how to go in there and create a little bit of a hedge. But it's also nice that we update these with the ratios for pairs trading, which we've seen people growing in a lot of interest here.
Yeah, this is an amazing portion of the newsletter. And what we're providing to people is literally what market makers and professional traders at prop shops are using for pairs trading and for hedging their positions. And I love the little tagline of this section, which is a buddy system for your portfolio. These numbers do change, of course, on a day-to-day basis, and we disseminate them on Monday morning. But this is also a page that you could quite literally print out or cut out and paste next to your computer screen every day, because they're so relevant in whatever you're doing. If you're trading IWM and you want to hedge some of that exposure, consider SM75, or you're scalping the micros and you want to put on a pairs trade there, these numbers can be useful for that as well. So a lot of information on this sheet, but a lot of valuable insight as well. You can just live with it.
And you can take solace in the fact that while these do change, of course, everything from the second that you put on a trade, the ratios and everything get tweaked just because of price movement. You could take solace in the fact that when I was at the Board of Trade, we updated ratios every 3 months. And that's on the professional side. And market makers, it's pretty much the same way. They're not updating their software and their ratios every single minute of every day. You can feel comfortable, like Mikey said, printing this thing out and being like, I'm never going to be perfectly hedged, but I'm as close as possible here, and I can feel comfortable for at least the next couple of weeks. And yeah, that's the last section there. If you're not already a subscriber here from the Small Exchange, Nothing to worry about. I understand. $100 is a large investment here in your future trading. You can at least go to this URL here and check out the weekly light version that we're sending out to everyone. And we hope that you check out the expanded version of our small newsletter soon. But that is the how-to guide on the Small Exchange newsletter.